In today's episode, I'll talk about the new regulations that SEBI has announced for the F&O segment, and then I'll discuss how RBI is concerned about gold loans. Hello and welcome to the Daily Brief. On this show, we cut through the noise and simplify the biggest stories and trends that are shaping the markets. I'm your host, Kashish Kapoor. Today is Friday, 4th of October. For the first story, SEBI has finally announced regulations to reduce F&O volumes. And in this story, I'm going to break down what SEBI has announced. See, SEBI has been worried about the F&O trading mania that's taken hold in India. In the latest study, it was found that 93% of individual F&O traders between FY22 and FY24 actually lost money. So it's no surprise that SEBI is finally stepping in. They had already put out a consultation paper in July this year proposing measures to reduce speculative activity in F&O, and they've now finalized 6 key changes in F&O trading. Let's break down what SEBI has changed. Number 1, limiting weekly options to just the big indices. At the moment, traders can trade in weekly options on multiple indices like Bank Nifty on Wednesday, Nifty on Thursday, and Sensex on Friday. SEBI wants to restrict these weekly options to just one major benchmark index per exchange. So, for example, NSE might only offer Bank Nifty or Nifty weekly options. Similarly, BSE might only offer Sensex or BankX weekly options. Other indices will only have monthly expiries, which means fewer short-term options to speculate on. This is SEBI's attempt to dial down the speculative frenzy in the market. By cutting down on the number of weekly options, SEBI is essentially reducing the opportunities for traders to make high-risk short-term bets. Number 2, calendar spread margin benefit gets cut on expiry day. Right now, if you hold a calendar spread, that's when you've got 2 options on the same underlying instrument but with different expiry dates, like selling a weekly option and buying a monthly one. The margin required for this spread is reduced because the risk is spread out. Even on expiry day, you get to keep the margin reduction. SEBI will now remove the margin benefit for calendar spreads on expiry day starting from February 2025. This means that when one leg of the spread is about to expire, you'll need to put up more money to cover the position. Let's say you have a short option expiring on 31st January with a margin of Rs 1 lakh and a long option expiring on 28th February. Since your short position is hedged by the long one, you get a margin benefit and need only 50,000 instead of 1 lakh. However, on 31st January, that's the expiry day, this margin benefit will no longer be available and you will have to maintain the full 1 lakh rupees margin. Why is this, you may ask? Options nearing expiry tend to get volatile. Prices can swing a lot and the risks spike. By cutting the margin benefit on the expiry day, SEBI is making sure that traders have enough collateral to cover for these risks. So we don't see people caught off guard by sudden losses. Number 3, additional margins for options on expiry day. If you're selling options, your potential losses can be huge, especially if the market moves sharply against you. SEBI is now adding an extra 2% extreme loss margin or ELM on short option positions on expiry day starting in November 2024. This applies to all short positions, whether they were created earlier or on the day itself. Let's say you have a short position in Nifty 27,000 call option expiring on 30th October with a margin requirement of Rs 1 lakh. On the expiry day of this option, you will have to maintain an additional 2%. On expiry day, sudden price moves are common, especially for those selling options, and the additional margin is there to act as a safety net, ensuring that traders can cover any significant losses if the market swings unexpectedly. In the consultation paper released, SEBI noted that 20 to 40% of trading activity typically occurs in the last 60 minutes, leading to heightened market volatility, often driven by speculative moves rather than fundamental or news-based events. Number 4, increasing the minimum contract size for index derivatives. The minimum contract size for index derivatives like Nifty and Sensex futures is currently between 5 lakh and 10 lakh rupees. This was set back in 2015, but since then, the market has grown a lot. SEBI is planning to raise the minimum contract size to 15 lakh to 20 lakh starting in November 2024. By increasing the contract size, SEBI is ensuring that the derivative market stays suitable for more experienced and well-capitalized traders. The idea is to keep smaller retail investors from taking on too much risk with oversized positions. Number 5, intraday monitoring of position limits. Currently, position limits, that is the maximum exposure you can take in a contract, are only checked at the end of the day. For traders, this is 5% of the total open interest in the underlying, or for brokers, it is 15%. Traders can exceed those limits during the day as long as they fix their positions before the market closes. Starting in April 2025, SEBI will require intraday monitoring of these position limits. Exchanges will now take at least 4 snapshots of the positions during the trading day to make sure traders aren't exceeding their limits at any point. By monitoring positions in real time, SEBI ensures that no one can temporarily bypass position limits and take on too much risk. And finally, number 6, paying the full option premium upfront. In 2020, SEBI cut down on unchecked leverage across the board by implementing upfront margin requirements. For equities, traders are required to pay a minimum of 20%. For futures and option selling, traders need to bring the span and exposure margin requirements upfront. However, upfront collection for option premium was left, and they continue to be collected at the end of the day. Given that when you're buying an option, you're already trading the risk. Most large brokers generally have been collecting the premium upfront even before the regulations come in. Some brokers would let them use borrowed money or collateral to cover it, allowing them to take positions without having enough money in their account, essentially providing additional leverage for an already leveraged product. However, to avoid any additional leverage for buying options, SEBI now wants traders to pay the full premium upfront, meaning no more borrowing or relying on brokers to enter trades. The next story is about how RBI is concerned about gold loans. So you know how regulators like the RBI are basically watchdogs of the financial world, right? They keep an eye on things to make sure everything is working the way it should. And every now and then, when they spot an issue, they step in before things get out of hand, or at least they try. This time, they have got their eyes on the gold loan market. In this story, we're diving into how the Reserve Bank of India is not too thrilled with how gold loans are being handled. In fact, they've just sent out a circular listing all the problems they've found in this space. And trust me, there are quite a few. But before we get into what's wrong, let's take a step back and quickly talk about how gold loans actually work. That way, everything will make more sense as we break it down. A gold loan works a bit differently from your typical bank or NBFC loan. In this setup, you pledge your gold as collateral and the lender gives you a loan based on its value. It's a secured loan, which means it's safer for the lender and it also allows borrowers to get lower interest rates. So it's a win-win for both sides. That's why this segment is growing fast, becoming super profitable, and it's still safer than most other types of loans. To give you some numbers, the gold loan market has almost doubled in the last 4 years, now crossing 7 lakh crore rupees. For lenders, it's especially attractive because it offers the highest return on assets, around 4.5%, compared to other types of loans like auto, housing, MSME, or microfinance, which only brings in returns between 1.8 to 2.5%. Essentially, lenders make more profits when lending against gold compared to other loan types. The process itself is fairly straightforward. You express interest, the lender verifies your identity with a KYC check, and then your gold is evaluated for its purity and weight. Based on that evaluation, the loan is issued almost instantly and the gold is stored safely until loan is repaid. Sounds simple, right? But here's where things start to get complicated, and the RBI has a lot to say about it. In their latest circular, they flagged several issues. Instead of diving into everything at once, let's break it down step by step so it's easier to follow. First up, the problem with third-party partnerships. A lot of banks and NBFCs are outsourcing key steps like gold evaluation to third-party fintechs or business correspondents. That's fine if they're doing it right. But the RBI found that these third parties are often evaluating the gold without the customer even being present. This is unethical and can cause errors. For instance, let's say a 20-carat gold ornament gets graded as a 22-carat. That sounds great at first because the borrower gets a bigger loan than they should, and the lender keeps a customer happy. But that's where trouble starts. If the borrower can't pay back the loan, the gold is auctioned off. The recovered amount is way lower than expected because the gold was overvalued in the first place. Now the lender has to bear the loss. And that's not all. These third parties also sometimes hold on to the gold themselves or delay sending it to the branch, which is another big no-no. On top of that, they sometimes handle KYC checks themselves instead of the banks, which RBI definitely doesn't approve of. Second, no monitoring of loan use. The lenders are supposed to check where the loan is being used for. Is it for personal expenses or business purposes? But the RBI found that in many cases, this isn't happening. Lenders are handing out loans without checking if the funds are being used for what the customer claimed. This becomes a problem because sometimes people take new top up loans to pay back their existing loans. This is a recipe for trouble because it hides the fact that the borrower is in financial trouble. Third, failing to track the loan to value ratio. Now, we've talked about how gold loans are given based on the value of the gold pledged, known as loan to value or LTV ratio. Currently, the LTV is capped at 75%. This means that if you pledge 100 rupees worth of gold, you can only get a loan of 75 rupees. But gold prices fluctuate, so the value of the loan can change over time. Lenders are supposed to closely monitor this, and if the LTV goes above 75%, if the price of gold goes down, they're required to ask the borrower to pledge more gold to cover the difference. However, the RBI noticed that many lenders weren't doing this. By allowing the LTV to exceed the limit, they're taking on more risk than they should, which could lead to bigger financial problems in the future. Fourth, cash disbursal limits. Here's a simple rule. Gold loans over 20,000 rupees can't be disbursed in cash. But guess what? Some lenders are ignoring that and handing out loans in cash well over the limit. This is a clear violation of RBI rules and it makes it harder to track how the money is being used. These issues aren't exactly new. If you've been following this sector, you might remember that back in March, IIFL Finance was actually banned by the RBI from issuing any new gold loans. Why? The RBI found similar problems with how they were handling these loans. That ban was only recently lifted in September. So why is the RBI cracking down on gold loans now? Well, it's because banks are jumping into the game. Traditionally, banks kept their distance from gold loans because of its high operational costs involved. But now they've changed their tune. Banks like HDFC and Axis, who weren't big players in the space before, are now aggressively expanding their gold loan portfolios. With the RBI becoming cautious about the growing risks in unsecured lending, many banks are now turning to safer options. Gold loans, being secured by physical assets, have quickly become a very attractive product in the retail sector as a safer alternative. You can already see the shift happening. Banks held a 36% market share in the gold loan segment in FY22, and that went up to 39% by September 2023. And it's probably grown even more since then. So here's the deal. Banks want in on this growing market, but the RBI doesn't want to see another situation like IIFL Finance. That's why they launched this circular, to prevent those same kind of lapses from creeping into the banking system. At the end of the day, the RBI isn't saying that gold loans are bad. They're just saying, let's clean up the mess and do clean business. They want to make sure that banks and NBFCs are following the rules and not taking shortcuts. This circular is their way of giving everyone a heads up before things get worse. And now finally, some tidbits for the day. Dabur India expects a mid-single-digit revenue drop in Q2 FY 2025 due to weak demand and heavy rains affecting out-of-home consumption. This marks the company's sharpest revenue decline in 4 years, dragging down its stock by 7.7%. Number two, a strike by 45,000 US dock workers at 36 East Coast ports is disrupting trade, affecting supply chains during the holiday season. This could significantly impact the US economy and India's exports, with potential losses exceeding $1 billion daily. Third, the credit quality of Indian companies has improved post-moratorium, with rating upgrades significantly outpacing downgrades. CRISIL, ICRA, and India Rating have reported higher credit ratios, signaling strengthened corporate health and boosting investor confidence. Number four, top Indian engineering firms saw strong order inflows in H1 FY24, driven by infrastructure and capital goods demand. L&T led with orders worth 47,500 crores, while firms like BHEL and HAL also reported substantial new contracts. These were the big stories of the day. I'm your host, Kashish Kapoor. This is the Daily Brief. I'll see you in the next episode.
Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.